Take a deeper look at what this all means for your money and your investments. I'm joined by Tony Drake, certified financial planner and founder of Drake and Associates. Tony, welcome.
Thank you.
All right. How should investors be looking at the inflation data this morning?
I think there's really some conflicting data. Clearly from the market reaction, markets were hoping that the CPI data would have supported this story of let's cut soon, 6-8 times this year. And that just didn't happen, right? Markets were predicting 4 to 5 cuts. I think the good news when we look at the market predictions is that's starting to come more in line with the Fed's. If that continues, that could be supportive for the market. You mentioned core CPI was up. I really do like that core number, and it came in a little bit hotter than analyst estimates, but it was also the smallest change. But, markets didn't get that supportive story. I think you have to look at CPI, though, with a little bit of judgment. Right? Rents are actually flat or down when we look at indicators that are really more current and timely, but CPI is still showing housing costs through rents is rising. And, I think that could be problematic to the number. Important to remember as well, January and February, really volatile months for CPI. It's a time period when companies tend to raise their prices. So maybe we got to get, past the start of this year to really see where inflation is at and what effect that's going to have as far as cuts for this year.
So how would you interpret the stock moves today? I mean, we do see the major indexes down. Probably no surprise that the NASDAQ is underperforming as it is more sensitive to interest rates. Of course, driven by inflation, that index down almost 2%, but still right within record highs. How do you interpret that?
Probably not that surprising, right? I mean, we've seen a big run up in the markets, a lot of enthusiasm, especially with this magnificent seven, or maybe it's the, strong six now. I don't know what you call it, but, definitely not a surprise on the NASDAQ side. I think we're going to see how the markets interpret this long term. I think the reality is inflation is still trending down. This is not the report we wanted, and this may mean the Feds need to stay higher for longer because they really do need to be cautious. Worst case scenario, they cut and we have to raise again. So I think the markets are going to watch this and we may see some short-term reactions. Hopefully it doesn't stick for the long term.
What's been your takeaway from earnings so far, Tony, in terms of how corporate America is faring amid all this?
That's really been the interesting part. The earnings have been pretty strong, right? And that's why we've really seen this driving market enthusiasm. I think consumers are still spending, right? And that's going to be a challenge for the Feds. As long as the consumers are still feeling a little bit more confident in spending, that's really going to help. And we're seeing that in a lot of those retail names and some of these earnings reports that are coming out. But, I think we'll continue to see that strong. I think we're going to be very data dependent this year. Maybe June might be off the table. We'll see what happens after these first couple months here, but I think these positive earnings reports, real high percentage has been great. Important to remember, though, those were revised numbers, right? So they're outperforming some kind of reduced numbers. So you got to keep that in mind, but the markets seem to be liking it.
Okay, let's talk more about the Fed. Tony, I know you've referenced it several times. We are always talking about it here on a daily basis as it pertains to interest rates and thus the stock market. How do you think the Fed interprets a report like this and the message that it could send to markets?
I think they're going to get the sense that what they're doing is correct, that this cautious action they're taking is the right move. I think it may give them some pause to not cut rates nearly as much as maybe anticipated. The challenge we have is Jerome Powell essentially promised us he's going to cut rates, but they have to stay data dependent. Again, I think the worst thing they could do is cut and then come back with an interest rate rise later because they cut too soon. And they've really taken this very cautious approach, and I think this is going to continue to support that direction.
The other major factor, at least that we know of right for now, is a 2024 presidential election. Of course, we won't get that until the fourth quarter in early November. But is there any way that investors should be preparing their portfolios in the wake of that?
These federal elections tend to be very volatile time periods. And so I think it's important to remember that we're probably going to continue to see some volatility this year. all depends on time horizon. If you're a long-term investor, I think there's some general trends, earnings reports, inflation, not the report we wanted to see today, but inflation is trending down. Feds are now starting to talk about cutting rates. That would be good for the market. So long-term, we're going to move in a great direction. Short-term, though, you have to stomach some of the volatility that's likely to come from some of these dramatic statements that may come from the candidates that cause some fears in the markets.
How could the breakdown of the election and, of course, what we see in Congress, right, in terms of a checks and balance system, impact inflation? I would imagine, Tony, and correct me if I'm wrong or if you have a different opinion here, but I would imagine as we get closer to the election, that word inflation is going to be a key focal point, at least for the GOP in this race.
Yeah, that's for sure. We're going to hear it over and over, right? And I think the component we have to think about a little bit is we're really running a budget deficit that is the largest it's ever been at full employment. Generally, that larger debt to GDP ratio happens when unemployment is high, and we're pretty darn close to full employment. So inflation is still out there. It's nagging, right? We're all feeling that when we go shopping. And if they don't deal with this debt, inflation is going to continue. We're going to have to pay the piper at some point. And that's either going to come in the form of long-term rates rising or the dollar weakening in the form of purchasing power. So I hope that that's a focus in this presidential election. I'm doubtful, but, we will hear the word inflation a lot, and I hope someone starts to deal with this.
Okay, well, I'm glad that we could talk about that, given the news and the data that we got today, how it relates to the Fed and obviously stocks. Tony, for investors watching, do you recommend that they stay the course, regular allocations to their 401k? Is there anything they should be buying or selling in this market?
I think, for long-term investors, for retirement, you want to stay the course. A well-balanced portfolio does historically perform for the long term. When you try to time these markets, it can really sting you, and it generally doesn't work out real well. If you're a shorter term investor, I still think there's some opportunities. When you look at this magnificent seven, still some, it's high, when you look at a PE ratio, but if you look at a PEG ratio, profits, earning, and growth, tech continues to look strong, even though they may feel a little bit high right now. When you compare it to that growth that's possible, I think there's some great opportunity out there. So you want to be careful. If you're a short-term investor, be selective and make sure you're choosing quality names.
Any specific stocks that you like for short-term investors, even for long-term investors?
Yeah, we really like some of these technology names. In addition to that, I really like some of the opportunities. I think some of the infrastructure spending, that impact on the economy is still yet to be felt, and there's some good opportunities there. So again, you want to be selective. You really want to be careful and really think about time horizon. Safest bet, if you're a long-term investor, is have a nice balanced portfolio. Going to have some winners and losers over different time periods, but long-term, it should really perform for you.
Tony Drake, founder of Drake and Associates, joining us from the Midwest, where I hail from. Tony, thank you.